This is Alan Bush with the Daily Financial Forecast for Tuesday, November 29th. Starting out with the stock index futures, this market holding up relatively well in the overnight trade. We did see a bit of a bounce with the GDP numbers coming in stronger than expected. GDP up 3.2%. The guess was up 3%. We do feel that the Fed is on track to raise interest rates at the upcoming meeting on December 14th. But even with a Fed funds rate increase, we do believe that stock index futures will continue to advance. Just another 25 basis point increase in rates is just not enough to derail this bull market in stock index futures. So the long-term trend still appears to be higher. I would look for further gains this year and additional strength well into next year for all of the major stock indices. Now, moving over to the currencies, the dollar index firming up, of course, this with the GDP coming in stronger. Personal consumption also better than expected. So prospects of a rate increase from the Fed are on track, and that remains a very dominant supportive influence for the dollar index. So I would look for additional strength in the greenback up until the Fed meeting on the 14th of next month. Once we get that rate increase, which we are anticipating, there could be some profit taking afterwards. But for right now, look for the trend to continue, and that is to the upside in the dollar index. Seeing a little pressure in the euro currency. This after several economic reports in the Eurozone coming in a bit on the weak side. However, the pound firming after UK mortgage approvals coming in at its highest level since March. And the Canadian dollar and the Australian dollar also under some pressure. This with crude oil prices quite a bit weaker today. Interest rate markets very much underperforming the news at the long end of the curve. We have the 30-year bonds lower, even though you would think that they would be higher with crude oil as weak as it is today. So bonds are very much performing worse than the news, which has to be viewed as a sign of weakness. We did see a little pressure coming into the bonds with the GDP coming in stronger. Of course, there's that inverse relationship with the better economy and lower interest rate futures. So our long-term view is unchanged. We continue to look for lower prices, especially at the long end. That would be the 30-year bond. So any strength that comes along the way should be used as a selling opportunity for the 30-year Treasury bond futures. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.